My name is Matt Faircloth, and today we're going to talk about how decisions being made in Washington, D.C., including government shutdowns and interest rate changes, are going to affect real estate investors, if they affect us at all. There are major changes happening in Washington, D.C., and as I said before, one is the interest rate changes to the federal funding rate. We've been all waiting for the Fed to change rates for a while to start dropping. They hiked them a lot, and when they hiked those rates quite a bit, that did push up the borrowing rate for real estate investors. So like, if they pushed it up, when they start to drop the federal funding rate, that should drop our rates for real estate investing and for home buyers, right? Wrong. Here's the problem. Although borrowing rates for real estate went up when the Fed started to change the rates, they're not directly correlated. So if the Fed increases the Fed funding rate by 0.25%, 0.5%, or something like that, it doesn't directly affect the rate that we pay when we buy real estate, whether that's for a single family home that we might want to live in, or whether that's for an investment property like we're here maybe watching this about. Those things are indirectly linked. What really affects borrowing rates for real estate is the Treasury notes. You're a kid, your grandma might have given you a Treasury note. I had a few of those, or she gave me a 30-year Treasury note or something like that. All that is a loan to the federal government at a certain percentage rate where you buy the note, meaning like you pay a certain amount of money. And that's a note. It's debt to the federal government. They pay a certain interest rate on it, and it floats up and down. And the rate on those depend on how much people are willing to pay for the note. And it floats up and down based on consumer confidence. People tend to run to those things for yield. And if things aren't going as well in the stock market, you see bonds and things like that go up because it's a secure investment. All the things. They've gone up because of other things increasing, such as the federal borrowing rate. And it's also become a place for people to run for yield. It's also gone up because people are selling these bonds because they're not as confident in the United States government anymore because of everything else happening in inflation and all that, that not as many people want to buy those 5 and 10-year notes. So for all the reasons, those things went up together, but they don't necessarily have to go down at the same time. And so when the Fed cut their short-term borrowing rate, which is what they cut, that doesn't necessarily affect the rate for bonds and those kinds of things. Okay. So maybe it'll float down as consumer confidence comes back in and people decide that they'd rather invest in something else besides Treasury bills, right? Maybe it will start to come back down. That will then drive down the cost of borrowing money for real estate investing and for homes. What it does get changed by the Fed changing that short-term borrowing rate are other things that are tied to it, such as credit cards, such as small business loans, such as small personal loans, those kinds of things. When people borrow money personally, they can be tied directly to the federal funding rate, okay? So that will help. That will release some pressure on some of your tenants, your residents, people that are looking to move that might be carrying around some credit card debt. That will get reduced a bit by the Fed dropping the interest rates, and that will pump some more money to the economy. Economy speeds up a little bit, and that maybe ups consumer confidence, and people start to get away from investing in very conservative bonds and that drops the bond rate. Okay, so maybe it's an indirect correlation. It tends to work its way through a little slowly. So over time, it may drop, you hear me? It may drop the borrowing rate on real estate, but it doesn't guarantee to do that, okay? The bottom line, guys, is this is a signal that the Fed sees that the economy needs some help, that maybe the inflation problem that they had out there that they pumped all these rates to solve in the beginning, maybe that problem's now been ebbed a bit, and now they've started to drop rates because they can take some pressure off, and they see the economy maybe is slowing down. As you see, there's some job losses happening and that kind of thing. So maybe they're trying to seed and push the economy. That's only good for real estate investing, that they're going to start taking on initiatives, including dropping the short-term funding rate to help the economy, which will indirectly help real estate investors, likely free up some money for your residents. Not directly drop your borrowing rates. That maybe is a secondary spillover effect from that. Okay, so that's how it affects real estate investors. Let's pay attention. They've said they're going to drop the rates 2 more times in the next couple months. So that may start to snowball and affect real estate investing there too. Before we get going, if you guys have a 9-to-5 job, that's awesome. If you want to quit that 9-to-5 job, I've got a tool that'll help you quit that 9-to-5 job through passive real estate investing. It's called How to Quit Your 9-to-5 Job Through Passive Real Estate Investing. Pretty cool, right? So go to DeRosaGroup.com/tools and grab a copy of that free program. It's a video series you can watch It'll talk you through the step-by-step process that you can use to quit your 9-to-5 job. So go ahead and out there and grab that at DeRosaGroup.com/tools or in the description section below this video. Moving on to the next thing that's going on. You've all heard about this one, and this is the shutdown. Now, when I'm recording this video, the shutdown has just happened. It may continue, but here's the thing. The shutdown happens when Congress fails to pass a budget. The government obviously needs money to keep going, and they need to pass budgets. And a lot of times they have to increase the debt ceiling, meaning like, hey, you're only allowed to borrow this much. And, as you know, the government keeps borrowing more and more and more and more money. So sometimes the government has to approve increasing that debt ceiling so they can keep going and keep printing more money and keep digging us into further and further debt as a country. So that increase in the debt ceiling is sometimes what they have a showdown on. And sometimes is what we're looking at today, which is the failure just to pass a budget on what it is we're going to spend the money on. So what we're facing now is a government shutdown, air quote. It's not complete shutdown. It's not like nobody's at work in any of the government offices. What happens is non-essential government services close that are not needed, that are beyond that budget that's there. So really the government has this much money now because there's not been an approval to put any more money into the system. So they have to keep going with the money that they have. It will require long-term, if this thing keeps going more than like a day or two, there will be job losses, there will be program cuts, all those kinds of things to keep the government at this fiscal size. And guys, this isn't a political support for one party or another. So save all those posts. This is just facts about what's happening in the economy. It's good and bad, right? Because like I said, it could keep the government a little bit smaller fiscally, which is a good thing, but it also could create a lot of job losses if this shutdown continues for a long period of time, which is of course bad. You don't hear anybody losing their jobs, especially if these folks that are losing their jobs are renters somewhere. That's going to cause a decline in rental income for landlords, and as these people go into unemployment and have to find jobs, and it's going to create job losses, and that'll trickle down and everything like that too. So that's bad as well. It's kind of a bad with a little bit of good mixed in there too, perhaps. But either way, it's not the best thing in the world because it creates a bottom line of uncertainty. And uncertainty is what creates a little bit of turmoil short term in markets because people aren't sure what's going to happen. So the good thing is, on the pro side, these shutdowns have happened before, but they only last like typically very short time, day or two, maybe a week or two, and they tend to not affect real estate investing long term. It just creates some short term uncertainty, and maybe they can work it out, but it does something that bodes for the future because my prediction is this will not be the last time we have a short-term or a long-term government shutdown. It seems like the left and the right are not talking very well to each other. They're not cooperating. And so I think we're going to probably have more threats or actual shutdowns as it moves forward, which will throw little trickles of uncertainty into the market. And I think as real estate investors, you can take advantage of uncertainty because it might create not sure where prices are going to go and that kind of thing. It could create buying opportunities from nervous sellers that are like, I'm not sure where this thing's going, so I'm going to sell. Especially if you're investing in areas where there are a lot of government workers that might be getting laid off, like around DC or around other hubs that there are government offices. So maybe that's a tip for you guys to go look around places that there are government offices, because those landlords that are relying on government workers to occupy their properties might be getting nervous and say, you know what, that's it, I'm out. If the government shutdown currently or one in the future it lasts more than a day or two, right? And there's indications they're going to figure this thing out. But if it ends up becoming a bit more of a showdown, here's what likely will happen. People will tend to run towards safer investments like securities, bonds, those kinds of things. And that will cause interest rates to go down as people invest in treasuries. More money comes in. That supply demand kind of thing that causes the rate to dip a little bit if a lot of people start buying treasuries. So maybe that's something that happens if this government shutdown lasts for more than a day or two, right? So that's maybe something that's good for you as a real estate investor or as a home buyer. The other cons that could happen, really bad things that could happen if this thing lasts more than like a day or two, is government services that are either deemed as unnecessary or on the chopping block in general, such as housing support, like Section 8, that kind of thing. That could become harder to get or become more bureaucratic, because if they do start laying people off on a longer shutdown, it will become harder for your tenant to either get approved for those kinds of things or to get the support that they need as your resident for housing support or whatever that may be to get approved. There's just other things in general, such as FHA loans, VA loans, USDA loans, and those kinds of things. They're not going to go away, but they're going to become harder to get if the government needs to start laying off a percentage of the workforce that provides some of the things that affect real estate. Again, Section 8 and government-backed loans. Also, other things indirectly you might not even think about. Things like insurance are indirectly, sometimes directly affected by the government, by employees through FEMA and through support services the government provides for us to get data, including job reports and data that we use in business to help us make decisions. Some of those things are produced by the government. If the government ends up having to lay off or pull back or freeze salaries at some of those workforces that are out there, that data might become slower to get a hold of. And that puts us a little bit more blind as a real estate investing community. So that's going to be a little bit of a pain in the butt for us to deal with if it's a longer time. That just means it's going to be slower to get data and slower to get some things done as a real estate investing community. Now, again, if this thing prolongs for more than a couple of weeks, you're going to see some the stock market really hasn't sneezed at all on this thing, because I think a lot of people believe that the government's going to open right back up in a day or so, and they're going to decide to kiss and make up and make nicey nice. But if that happens now, great. If a government shutdown happens again and they decide to really have a Mexican standoff on this thing and it goes for weeks or even a month or whatever it is, you're going to see major effects in the market, potentially opportunities for real estate investors to go buy some properties that are immediately falling into distress, or folks that are hitting the panic button and that. So keep your eye out and dig into your markets for maybe distressed sellers or people that are just saying, you know what, enough's enough, I'm out, if this thing drags out for a little bit longer. And also maybe look for people running for yield and running for security and getting into bonds, which might drop some short-term rates. I don't hope that happens, because it also creates a lot of job losses and a lot more uncertainty can kind of cause anything to happen. It's like all bets are off kind of thing. So what I hope happens is this thing opens back up and we turn into just a continued healthy economy and let the economic cycles work their way through and everything like that. Maybe you hope the stink bomb thrown into the schoolroom stinks it out, and a lot of people run out of the lunchroom, and you see who's left standing, and you're able to take advantage of some opportunities. Depends on if you are a fan of chaos theory or a fan of slow and steady kind of thing. Depends on your investment philosophy. So that's my thoughts today. Guys, if you stayed all the way through this video, that means you like something that we have to say here at DeRosa Group. So take a minute and like this video, subscribe to this channel, and share this video with somebody else in your network. Maybe put it on Facebook and your social feeds so you continue to spread the word about the great words that we're saying here at the DeRosa Group with free real estate advice here on this YouTube channel. One last time, go to DeRosaGroup.com/tools and grab a copy of our How to Quit Your 9-to-5 video series, free training, how to quit your 9-to-5 job through passive real estate investing. Join us as a passive real estate investor in the real estate investing community full-time if that's what you want to do through that video series. Go out and grab that now. Thank you for watching, guys. I appreciate your eyeballs always on this YouTube channel. Grateful for you. Have a great and profitable week.